So, Steve, when we last got together in June, the closed-end fund market had a pretty tough month. I think total returns were in the neighborhood of 300 or 400 basis points off. So, I noticed where the S&P was up in July and the Barclays Ag was up in July. So, how did that filter through to closed-end fund returns?
Unfortunately, the closed-end fund market had a third consecutive loss. The average performance for a closed-end fund was down 50 basis points. That takes the year-to-date decline to about 250 basis points. And so as you said, the broader U.S. capital markets recovered in the month of July. And frankly, they've had pretty good years for year-to-date numbers. The S&P is up 300 basis points. High-yield bonds are up 2%. The Barclays Ag is roughly 0.5% to the positive. So you have pretty decent returns for U.S. asset classes. But closed-end funds, as I said, have delivered a 250 basis point decline year-to-date. And that's obviously a relative loser. And actually what's even more interesting is the correction that closed-end funds have had since the spring. I mean, there was a time when closed-end funds were outperforming the broader market, but they've recently gone through a 6% correction total return from late April to late July.
So, Steve, how about the discount story? When we closed the month in July, we were around 9% for the broad market. Discount still wide, and is your view on their attractiveness still the same?
It is. I think discounts are certainly still wide during the month of July. They widened out marginally. The average is about 9.2 versus 9% at the end of June. But again, I mean, discount average is 9.2, but we're seeing hundreds of funds in the mid-teen discounts. And you can really buy any asset class that you like at a discount from 10 to 15% off par value. And so I think is just the obvious call is to look at your portfolio and evaluate what kind of market risk you're already taking. Look at your mutual funds, ETFs, cash bonds, and equities, and say, can I get this exposure at 90, 85 cents on the dollar? And I believe that 9 times out of 10, you're going to find a very similar market exposure beta in the closed-end fund market, but you're going to have that nice discount, which is very attractive on a historical basis. We haven't seen discounts this wide since the spring of 2009, which was a very different time for the capital markets. And so to me, it's a pretty clear relative value proposition. And we're seeing a lot of fund companies, insiders at these companies basically buy up this opportunity. You're seeing chief investment officers, portfolio managers, board members just scooping up closed-end funds for their personal portfolios because, like us, we recognize the discount opportunity and think it's a good time to put dollars to work in closed-end funds that are trading cheap, not necessarily adding new exposure, but replacing exposure you already have.
Steve, thanks for your time this month.
My pleasure.